Welcome back to World Ledger with Coco Key. Today, we have a truly exceptional guest sitting at the intersection of crypto policy and financial regulation, Jason Brett. Jason is the former FDIC regulator who has led government relations at both Digital Chamber of Commerce and Consensus, and is a regular contributor to Forbes. If you want to understand what's actually happening in Washington, from the Clarity Act and the battle between the OCC and the banking industry to the historic commission-level interpretive guidance for crypto assets, this is the episode you cannot miss.
Welcome to World Ledger with Coco Key, your gateway to global perspectives on Bitcoin, blockchain, crypto digital assets, and AI. Everything here is for informational purposes only, not investment or financial advice.
Jason, welcome to the show. There's a lot happening right now. It's very exciting and honestly a pivotal moment for the industry. I just want to jump right in. Let's talk about what's happening legislatively and then work our way through what regulators are working on. Let's start with Clarity Act. It passed the House last summer with surprisingly strong bipartisan support, but it has been stored in the Senate ever since. From your vantage point, what has actually held the Senate back?
I think the market structure bill passed, like you said, with a pretty strong bipartisan grouping. But for the House of Representatives to vote on that bill, they were able to just essentially bring it to the floor. There wasn't a lot of restrictions, but the Senate is much more restrictive. And it has this idea called cloture, where you need 60 senators to agree to even vote on a bill. When the Genius Act passed regarding stablecoins, everyone remembers from July of last year, the hard bargaining point was even though the Republicans have a majority of senators, that doesn't mean that they have 60. And so you need some Democrats to agree with Republicans and make the bill bipartisan for it to even move to where it can be voted on. Now, once you get past that hurdle, then you can have a simple majority of 51 or more, or 50 votes in the vice president voting for a bill to get it passed. We're not even at the floor, but the dynamic exists such that if there's going to be a reasonable chance that this bill can even be voted on, you're going to need a certain number of Democrats to agree with it. Right now, it's been in committee, and the big change is there's a couple of major concepts that was not as simple as with Genius Act. It's not that stablecoins were simple, but it wasn't very controversial. It was about this is the way the stablecoin is going to be regulated. It was a dollar backed. And once people accepted that and bought into that, we're now at the point where there's just a lot going on still, because now Treasury and everyone is moving into the regulatory phase of issuing rules about how stablecoins are regulated. When you talk about market structure, Coco, there's really three elements, and the three elements were called out by Brian Armstrong of Coinbase when he got worried about the last consideration of the market structure bill where it got stalled. The first was about tokenization, and the second was about DeFi. Now, tokenization is a relatively new concept in Congress, even though it's been happening for some time now. And the problems of tokenization is the approach that you want the SEC to take, and how you want to write a law to not necessarily inhibit the SEC from being able to offer tokenized platforms. When it comes to DeFi, that's a very complicated subject, and that's been something that's been fought about for years. In market structure in 2022, there's this huge blow up, right, between CZ and Sam Bankman-Fried, and they were fighting, and then Binance called out FTX. We found out what was on their books. That all started at Congress because Sam Bankman-Fried and FTX were going around criticizing Binance, and then someone revealed what was happening with the FTX books, and it was all while Sam Bankman-Fried was working on a controversial bill where he was saying, let's do market structure and let's just say DeFi isn't allowed. And the DeFi people obviously really objected to that. So that's different sides, viewpoints, different tribes, so to speak, within crypto that don't necessarily agree exactly how market structure should land. The third rail, which really is the third rail of politics, is stablecoins. We just passed this law, Genius Act. We're doing the rulemaking now. the banks really got involved, and the banks and the crypto lobby started fighting. And that didn't happen with the Genius Act, but it is happening with market structure. And so the crypto lobby has advanced very quickly. It's very impressive. It's grown to be a very strong lobby. But the bank lobby is still the most powerful lobby probably in DC. And so they've gotten their hands on this bill. They want to limit the amount of stablecoin yield that's even permissible under Genius, where it's not that a Circle issuing a stablecoin would be able to pay yield, but Coinbase in the aftermarket could pay yield if you're holding your stablecoins with them. And the banks want to disallow that. So for all those reasons is why we've been bogged down for some time where the crypto industry can't agree, and the crypto and bank industry are affecting, both Republicans and Democrats. And it's funny because actually some of the Democrats have become more friendly with the banking lobby as a result, where usually it's the other way around. And so all these dynamics have led it to where it's been really a very difficult challenge. What I'd say, and as I think is important for your listeners, Coco, is that at the end of the day, the banks are pointing to this concept that if we allow this yield on stable coins, we could end up having a bank run, like people moving their money out of banks. And it's a fundamental safety and soundness issue where they might seek interest or yield somewhere else than deposits at a bank. And the way at least we still work here is banks need the deposits in the bank to be earning something and attract customers. And then the banks can use that money to then issue loans and mortgages to people.
So there are three elements or three hurdles the Congress or the Senate has to get over. The one that surfaces most is the stablecoin yield. Brian Armstrong of Coinbase withdrew his support for the bill over coin yield dispute. That frustrated a lot of people from the industry, including President Trump. What is your thought? Do you think that his concern makes some sense? Because some people from the industry believe we should do the right thing versus passing a bill which is not good enough.
So there's three elements to it, right? I think the first element is with the stable coins, can you pay yield or not? Base uses that to help with their business. And if other exchanges are going to use that model to have a loss leader, offer interest in stable coins, it's going to attract people to the platform. The whole idea is that crypto is trying to provide an alternative to people who don't want to just rest their money in banks. That gets really controversial, right? That has been the big fight between the banks and the crypto lobby. With tokenization, that debate specifically centers around whether in law we should tell the SEC to do a rulemaking for tokenization and at the same time allow for exemptions. That's where it gets a little tricky. I personally think they don't conflict, but Coinbase does, and it's gotten very political. So the idea is for years, the SEC has always been able to do like a sandbox or an innovation exemption. And you've been hearing Paul Atkins talk about he's going to roll out an innovation exemption for tokenization. And Coinbase and others believe that if you put in something in law that requires the SEC to do a rulemaking on how the tokenization markets function, that could potentially limit the idea of an exemption. Some people want the broader rulemaking and authority, and a lot of this whole debate around tokenization also has changed market structure a little bit from what it used to be. Market structure used to be, you start out in the SEC, and then you can move to a commodity if you're decentralized. But you had other exchanges like a NASDAQ and others who got interested in Bitcoin and wanted to be able to offer Bitcoin on the exchange as an option. And NASDAQ's asking to do a product where for 10% of the price of Bitcoin, you can do a bet or option on whether the price is going to go up or down. But to be able to do that means Bitcoin can't just be a commodity. Bitcoin also has to be regulated at the SEC. So this whole tokenization move, it's changed the target a little bit. The biggest problem within the crypto ecosystem, and also gets a lot of pressure from banks, is DeFi. A lot of people see DeFi as skirting the rules altogether. And Tom Emmer is the BRCA, or the Blockchain Regulatory Certainty Act, that basically says a blockchain platform isn't a money transmitter in any form as long as it's not custodying the digital asset. A lot of the blockchains like Solana and others want that kind of protection. They don't want to be swept under what Coinbase and Binance are going to have to follow. Because remember, at the end of the day, the market structure is really about how centralized exchanges are going to be regulated, not DeFi. So to keep DeFi clearly out of the scope of this bill is a major priority for a lot of people who've been in the crypto industry for some time. So any one of them can be an issue. This is really timely discussion because Paul Grell is saying today, oh, really close. What I wonder is, does he mean really close on stablecoins, or really close on tokenization, DeFi, and everything else, where everyone can be happy and we can move it to a markup out of the Senate and onto the floor?
I can see there are different groups of people. Some of them may not want to compromise any of the three elements. Some want to focus on just the one, which is most important to their business. Do you see any path to resolve all these three elements before it goes to the floor vote in the Senate?
Yeah, I think the path I see, to be honest with you, is our president becoming much more active in wanting this to happen than not. His latest remarks have been like, I hope I get a chance to pass the bill if it can make its way out of Congress. But I think Congress needs a little more forceful. Like, we now have the SAVE Act. He's not going to sign another bill until he gets this on. If Trump wanted to, he could be much more vocal in saying, look, iron out these differences. I want that bill on my desk. I've been wondering when we'll see a little more of a push from the president's office. Part of the issue, as we've all seen, is behind stepped away. Now Patrick Witt filled his shoes. He's very competent as the president's executive director, even though he didn't really come from a crypto background. And now David Sachs met his exemption. After 130 days, he's no longer the crypto czar. So who at the White House is leading this effort or leading this charge? And if it's not going to be Trump, is it going to be Sachs again? Who's going to be over there telling senators, hey, I want this before the midterm elections? Because the time will run out. A lot of people are seeing that we might end up with the House of Representatives being Democratic and not Republican. That's going to make it very challenging for us to have a window again to have this bill.
Do you think it's still realistic for the passage this year? You're in DC all the time. What is your take?
I have to tell you, to me, it's a 50-50. It's a toss-up. I don't think it's unrealistic to see it happen, but the challenge is that we're up against the timing. And anytime you're in that year where there's going to be midterm elections, things just become more challenging to get done on the floor. People are campaigning. My bet would be 50-50. And I think if it does happen, it might even happen in a lame duck session in December after the elections. But there's just so many variables, like we were just talking about, that could steer this the wrong way. I think the way it gets to be passed is we get more force of will from the White House that it needs to be done.
There is also some complexity when it comes to this bill. First, you need to reconcile the versions from the two committees in the Senate. After the Senate passed the bill, then you still have to align the Senate's version with the House version. Am I right?
In the case of the Genius Act, the Senate version was very different than the House version. Trump had asked that when it goes to the House, they just approve it as is. And the House agreed to do that. The House didn't have to. They could have re-voted on it and said, wait a minute, this is different, or have a conference. Now, in market structure, is the House just going to agree to go along with it? I'm not sure. You might have enough people in the House who want to say, no, we need to conference it. So you're absolutely right. If there is changes in what the Senate bill gets done, it might take longer. The difference is what they leaned on with the Genius Act is in the House, you just need 50% to vote on it. You just need a simple majority. In the Senate, you need 60 that includes some Democrats. The Senate version is more on par with a balanced approach than the House, because that was really just Republicans that did that bill. But with the Senate, we know it's a more balanced. It has more force because it was 60 votes rather than 50-50. That's why the House decided to recede and accept the Senate version and let it go to the president.
That makes sense. Conclusions from what we just talked about. There are three hurdles: the DeFi, the tokenization, and the stablecoin yield that the Senate and the industry have to overcome. A lot of compromise may have to be made within the industry and between the banking industry and the crypto industry. Hopefully, the administration can push harder. The president can push harder for this bill to pass. 50-50 chance.
If I could say one more thing on this is people need to remember that what happened a couple of months ago wasn't really the best outcome from the crypto side. When Coinbase came out and said, we can't support the bill as it is, they did that the night before the bill was going to be marked up by Senator Lummis and all these senators. I tell a lot of people in crypto is to the U.S. senators, that was almost the equivalent of a rug pull. That's like the night before you get married and they say, the whole thing's off, I'm walking away. Coinbase did that for tactical reasons because they really felt the bill was disadvantaged. And like you said, many people say, a bad bill is worse than no bill. Let's just not do it. But people also have to remember, we've been fighting so hard to have a crypto bill that for one of our crypto leaders to say, no, I'm going to step away. I think we lost a little bit of momentum for some of the senators. They're still working with the crypto industry, but they're very fatigued. They're so tired of talking about crypto. So I think we just need to know that as an industry. It's not just that this might be a last chance, but we've tried everybody's patience. And at some point, we may need to negotiate a few things away to just say, at least let's get some clarity for our industry. I think that's important.
I totally agree. You have to accept something on the table, understand what to compromise and what not to. I was shocked when Coinbase cut off the support right before the markup. Now let's talk about OCC, Office of the Comptroller of the Currency, and National Trust Bank charters. Since last December, the OCC has conditionally approved a wave of crypto-native digital asset and fintech companies for trust bank charters. And additionally, the OCC has proposed a regulatory amendment replacing fiduciary activities with broader language, effective April 1, which is yesterday. Traditional banking groups such as the Bank Policy Institute are pushing back against OCC and threaten to sue. So how likely is the lawsuit? On what grounds? It sounds very serious to me.
I don't know if the Bank Policy Institute will sue or the Conference of State Bank Supervisors. They seem to be the ones most likely to sue because they've been talking about the effects of this. When you talk about the amendment that was made in the language, I think that's a good place to start. OCC Comptroller Jonathan Gould, who I always remind everybody was with Brian Brooks, when Brian Brooks first introduced in 2020 the ability, including the letter 1175, the ability to offer these trust charters. They've always been able to offer these trust charters. And it's just a matter of what a trust typically has done. When you say it's a trust charter, what most people think about is a trust, a will, and a estate. That's mainly where there's a fiduciary who's managing all this money. But with crypto, it's not like that. Most of the time, if you brought up crypto to a trust bank, you're really just looking to store it. You're not saying, hey, sell my Bitcoin and Ethereum and Solana to make sure it's all managed correctly. By offering the idea of having it be more custody activity than trust activity, there's this question, are you not a trust bank? Because at least 50% of your activity should be on the trust side. They changed the definition to explain it's the operations of a trust company, which can include custody, and any related activities there too. They made that language adjustment because there had been some original confusion. This was interpreted, particularly the states didn't like. The Conference of State Bank Supervisors sees this notion as a real infringement on what they now offer with their state trust banks. They're probably going to sue. Bank Policy Institute, there was a rumor they might sue too. It's a real fight behind the scenes in policy circles. Large banks like Wells Fargo, Bank of America, they're all saying Coinbase just got its conditional approval today. All these other banks are getting conditional approval. And we're calling them banks, but they're not even a bank. They don't have deposits. They don't have mortgages. Why are we giving them this privilege of being a quote unquote bank when all they're doing is holding crypto? The truth is, the way the laws line up and the interpretations is, it's fair to say you can have a custody of trust. In fact, the large banks wanted that initially. They wanted a separate trust charter to do things like custody originally. I think it's more the fear that these banks would be operating and just focused on crypto that the large bank sees as a competitive issue. They have a lot of concerns that are fair too, because Wells Fargo, Bank of America, they want to compete. They want to draw products in this industry. And if you suddenly let a number of banks that are able to just operate solely with crypto, but not have the responsibilities of like bank deposits and loans, that can be a challenge. I don't think it's going to negate the trust the way it did. You're probably thinking of the fintech charter that OCC tried to do, and then New York sued them, ended up being canceled. But whoever starts their first trust business, Circle or Paxos or whoever, is probably going to be hit with a lawsuit on day one. But I think it's going to be a little harder, to be honest, because Anchorage has been around for 4 years. If they're suddenly going to sue over this trust charter issue now, you would have thought, where are you in 2021 and 2022? Why didn't you go to court then against Anchorage? So the fact that there's just one that's been existing all this time, I think hurts a little bit that argument.
That's a good point. Plus, this time, OCC has approved more than 10 companies. They have to sue more than 10 companies. I think Morgan Stanley also filed for charter bank as well.
They're going to be reviewed by the large bank division because they're already an established bank. So they're going to go through a different process and evaluation. The crypto or digital assets track is about 10 yet.
I want to go back and ask another question. These trust banks don't take customers' deposit, unlike other banks. What exactly is the most concerning thing to those big banks?
I'll give you an example of when I was working with a company as a consultant trying to set up to be a bank. And I was talking to the bank regulators, educating them on crypto and things like that. At one point, they just stopped and they looked at me and they said, Jason, how is this going to work? How's the bank going to survive if all they do is crypto? And I said, what do you mean? They said, the only way a bank makes money is by mortgages. It was a foreign concept to them that any bank on this planet could survive without making mortgages from the deposits. That's an old kind of concept that's ingrained in the minds of bankers is if you're not making mortgages, you're not making money and you're going to go out of business. It's not so much a threat to their deposits. It's a threat to the idea of what banking is and to the very way that they make a living, which is they believe it has to be with making mortgages. If you're not doing that, you're not a competitor, but you're simply not a bank. It's almost Goldman Sachs, Bank of America, Wells Fargo have decided they're in this club called banks. And now Coinbase and all these other companies are showing up at the club. We don't want to call them banks. We're really the banks. That's a lot of what this is about.
Understand. Crypto companies might be considered not elite in their eyes. They prefer to keep them away from bank category.
I always refer people to this, and I talked about this at a Bitcoin conference a while ago. E. Gerald Corrigan worked for Paul Volcker. He was at the Fed. He was the head of the Fed in New York. And Volcker told him to write an essay talking about the elite part of why banks are special. So he wrote this whole very famous essay, and it basically says banks are special because they have a discount window at the Fed. They're special because they offer FDIC insurance. They're special because they have this utility in the world where they're not only just banks, they're the transmission engine for the Fed. When you do monetary policy, the banks are all going to change their rates, and that's going to change consumer behavior, small business behavior. FDIC insurance is the backstop. It has the discount window. What that paper enshrined back in the late 70s, early 80s is that banks are special, and that if you don't have FDIC insurance, if you don't have deposits, if you don't have a discount window open at the Fed, that means you're not a bank. And I've given talks on this. I've shown Walmart tried to become a bank. Basically, the bank said, no, it has to be separate because the U.S. is very different than every other country because they believe there should be a separation between banking and commerce. This has really been laid out in these white papers, thought pieces. I guess to add to what you're saying, Coco, it's elite and they have the credentials because we have a discount window at the Fed and you don't. We have deposits and you don't. And my point is, whether you're Walmart or whether you're just a trust bank trying to offer some crypto product, to them, you're just not in their category.
I want to take the scenario very seriously. If the banks sue and the OCC loses, what will happen to the companies that already received the conditional approval?
I think there'd be a couple of things. I don't think the charter itself would go away. But I think there'd have to be a massive shift in their business models and in their behavior. Because I think where they would sue is what I was talking about before, in that like you're mainly just doing custody, like for ETFs or whatever. They'd say you can't do this anymore at the OCC level unless at least 51% of your activity is in trusts and estates. So unless you change your business model to make sure that at least half of what you do is focused on when you're a fiduciary and someone has an estate with cryptocurrency in it, that would probably be what you'd have to do. You would just have to either go back to the state level. Paxos would have to just do it in New York. They wouldn't be able to do it at the federal level anymore if they were going to mainly focus on custody. That's my opinion what would happen.
In the previous round of conditional OCC approvals in 2021, only Anchorage survived. Procedural, Paxos conditional approvals ultimately lapsed. How confident that the companies in this new wave will actually clear the conditions, assuming there was no lawsuit?
I think it's going to be up to the banks to be competitive. I don't really think it's going to be a regulatory issue. Let's be clear, Anchorage made it, but they got a matter requiring board attention within 7 months. For a lot of banks, that's almost like a death sentence. Anchorage survived, but like on one leg for a while. They were really limping along and they finally got that thing dismissed. You're probably going to have a runway for the next couple of years as these banks start to go into business. The banks are going to have to perform on their own and in the competition and show that they're meeting their targets to maintain themselves or just go out of business naturally. A lot of people have been talking about how Coinbase holds all the ETF custody. You're going to need different banks to balance that out. I think that's why Gould policy perspective has been, let's do BitGo, let's do Paxos, let's give other options. It's really a very diverse group that he's chosen for policy reasons, not, I like this company or not. He's selected a grouping, all have their own strengths to survive. And Gould would never approve them if he didn't think that they couldn't make it on their own.
Let's hope all of them will survive this time. Let's move on to the next one, the SEC and CFTC commission level interpretive guidance released in March. A lot of people consider that monumental or historic. Do you think the guidance deserves the word historic or monumental?
I don't like monumental, but I think historic is right because I did a story about this with Forbes Digital Assets, that these kinds of commission level guidances are very hard to be reversed. You need at least a majority of a new commission to get rid of it. And there's been ones that have been put in very unpopular. The example I gave is in 2010. Before that, the SEC put in a commission guidance just like the one we have. It was for climate disclosure rules. Republicans didn't like it, went back and forth, but the guidance has always stayed there. And in practice, companies to this day file climate disclosure risks with their SEC filings. So from that perspective, it is pretty historic. It shouldn't be the final answer because crypto to me is more complicated and it deserves something like a law to have a basis so it can't be reversed easily at all ever again and should be something that institutions can rely upon. But I do think it was historic because it also involves another agency. If it was just guidance from the SEC, it would be one thing, but to have the two agencies collaborating and working together and the CFTC signing off on it, saying, yes, all these things that you say are not securities, we're going to regulate over here as digital commodities. That's pretty impressive.
Two agencies speak with one voice is very unusual. Does this guidance supersede previous guidance in either of the commission?
There wasn't previous guidance to supersede at the commission level. There was staff level guidance in 2019, but again, that was just staff interpretations. What it does is it formalizes some of the staff interpretations from last year that were part of Project Crypto with Mike Seelig. What I mean is things like collectibles or meme coins. Now that it's at a commission level guidance, has more force and people can understand how they build something, that it's not going to be considered security. And particularly for investment contracts, it's not a security just by the fact that it's in an investment contract is a big deal.
For crypto assets, this is the first commission level guidance. Before, there was just staff level guidance. Am I right?
Yeah. What people hope to see, and maybe we will, is a follow-on rulemaking. A lot of times lawyers like to hang their hats on a public rulemaking comment period and feedback. So if there isn't a rulemaking and comment from the public, sometimes people think maybe that isn't as big as the interpretation, but it is still a big deal. The commission did vote on it, and it means you can rely on that to say this is how the commission is going to see a Bitcoin or especially the ones that they listed as not as securities. So that does give like a lot of insurance and a lot of assurance to these programs about how they can operate. It still doesn't mean things like fraud is okay. So if you do fraud or manipulation of prices, you can still definitely get in trouble for that, particularly at the CFTC, because they review for that. But it does mean from an infrastructure perspective, Coinbase listing these specific tokens now is not going to be something that makes them like a stock exchange. So it clarifies a lot when they dismiss lawsuits, now put something in firm to say, this is the way that the markets will generally operate. And Paul Atkins did say, look, this is just the beginning, and we just want to signal how we're going to be aligned while we wait for a market structure bill in Congress. I'm not saying one will be passed. I think what they're saying is they're trying to let the industry start to live the way they think long-term it'll ultimately be decided.
Is there still potential risk in the future if there was a new agency nominated by the new administration, which simply just walk it back and use other rulemaking?
Absolutely. Let's say Gary Gensler came back and he had a majority of commissioners, like two other Democratic commissioners. They had a 3-0 or 3-1 vote. Absolutely, they could change the interpretive guidance or change that to something else. But what I try to indicate to a lot of people is the history of it. If you look at climate disclosure rules, businesses didn't want to have climate disclosure rules, and they've had Republican SEC commissioners all the way back to Clayton in 2016 to 2020. They didn't allow the rules to go through, but the guidance never changed, and people just started doing it into practice. The reason I think this is a big deal is, yeah, you might have an agency that comes in that's very unfriendly. They might be very unhelpful, but I do think it would be a lot for them to reverse this. Then again, this isn't something as simple as a climate disclosure rule. Sometimes people really hate crypto more than anything. You're right, anything is possible.
Let's just assume Clarity Act will not pass in the near future. Is this guidance sufficient enough for the industry to survive, grow, and thrive, at least during this administration, without constantly turning into legal disputes and legal battles?
I think it allows them to survive, not thrive. I think it allows them to continue what they're doing, but you're going to discourage people from wanting to come in and spend all their innovation money on something because of that risk.
It's a temporary solution.
It's definitely a temporary solution. It means you're good for the next year or two, in my opinion. Most people probably will see it that way.
Before we conclude, I want to get your thoughts on your latest article on Forbes about Plume's general counsel's criticism of SEC's innovation exemption. We talk about the tokenization. I think one of his criticism is about the tokenization regulation, which is slow. In the article, you quoted him saying, when you put volume limits and product limits, you are not going to attract the large institutions. So does his concern have any merit?
Plume is what I call an example of a startup that got some regulatory certification, not necessarily have the view of a startup anymore. Early on in 2025, they wanted an innovation exemption. And they said, we need to do that first, and then we can build other things. Now in October, the SEC made them a registered transfer agent, which is a really big deal for Plume. Now they have a bunch of major companies like WisdomTree and others that want to kick off and do great things. They would want more than an innovation exemption because they probably would go beyond those volume limits that we just talked about, or time limits. So to them, the answer is an innovation exemption. An innovation exemption might help somebody like World Liberty Financial or somebody smaller who's just starting in the business. I will say that he has a point. If you look at Europe, they've tried to have a tokenization innovation exemption program. They've had it open for 3 years. And in 3 years, they've only had 3 companies actually participate. And it's been very low. So there is a point that maybe the innovation exemption could be done in a bigger way. That's why they want rulemaking. So you can just have everyone start to participate. And their argument is people won't really bring in capital to invest in tokenization companies until you let them do more than just like a sandbox. But I think they're going to be stuck with the sandbox because you have companies like Citadel, Ken Griffin, and others who made a point DeFi shouldn't really be let into this area. And I'm sure that they've objected to the idea of rulemaking for blockchain. They say, let's just give them a little sandbox to play in. When I did the interview, the general counsel said to me that part of this has become political with Coinbase and the tokenization argument because it falls into the whole debate over the Clarity Act. It's hard to say. I think the SEC has made up its mind. They're just going to do the innovation exemption. They're not going to do what Plume wants, which is a rulemaking. The reason they're worried, everyone's fearful that the time's going to run out. We're going to have a new SEC that's not friendly. If they would have already started the rulemaking, it takes 6 to 12 months to get it done. But if they wait to do it until 2028, 2029, they're going to start it, but then they have to leave and then new people come in and maybe they just throw it off in the corner. They're just nervous like everyone is with Clarity Act, with the OCC charters. People try to hurry up and get them done and established before there's a change in attitude.
For the sandbox without rulemaking, there is some uncertainty, but if it can be tied to the passage of Clarity Act, which includes the tokenization element, that would be good news for the companies like Plume.
It would, then they would by law have to do a rulemaking. But I think Plume would like the SEC to start doing the rulemaking now. I just don't know that they're going to necessarily get that.
It has been an extraordinary conversation, Jason. So we are at a critical point with legislation in the balance, charters under legal threat, and fresh regulatory guidance that the industry is still trying to unpack. Where can people find your work and follow your thinking on all of this?
Yeah, you can follow me on Regulatory Jason on X, Jason Brett on LinkedIn. Also, there's my Forbes senior contributor articles, so you can see me on Forbes as well.
Thank you for listening. Your support means the world to me. Share this episode with friends and family, and don't miss out on my newsletter, worldledger.substack.com, for the latest updates. See you next time. Bye-bye.